Mentorship for March 5th, 2021. This is a daily chart for dollar index. As you can see, we have had a nice rejection off that rejection block here. And I'm going to talk a little bit about, for the lesson today, why I felt that if it did this run into that rejection block, it would be problematic, because that would spell this out as a potential reversal. Let's add the annotations in here. All right, so here we have the market reaching up into that volume imbalance. I mentioned this would be a draw on liquidity. Should we take out this high in here, if it continued up, we would trade into here, and we got that on Friday. Institutional order flow entry trail here. I commented on it as a potential precursor to all of this and attacking the buy side liquidity here and the buy side liquidity here. Buy side imbalance, sell side inefficiency, it traded into that here, but all of this decline with the institutional order flow entry drill was also a bullish breaker. Okay, so we have a low, a high, and the lower low. So I want you to take a moment and really take this all in. Rejection block we called as a potential warning. If we trade below and back above it, that's not what we want to see. The market rallies. Low, high, lower low, up close candle at the high, that's your bullish breaker. But it needs to trade above that. It does that here. Does it close above it? Doesn't need to. Just trades above it and back down into the range. What's the logic? This was a rejection block. The market had this imbalance here, which was indicating what? Displacement. So a lot of energy moving away from this low higher, attacking this buy side liquidity, and the algorithm remembers this inefficiency back here. So there's no bodies of the candles overlapping that. Okay, so that was one of the reasons why I felt that we would draw higher, was we were inside this bullish breaker. So here's your context there. We're going to drop down to an hourly chart. All right, here's the hourly chart on dollar index, and you can see the buy side imbalance in here and the breaker. Now I'm going to take off the daily annotations because I want it to be clean when I talk to you about the optimal trade entry. All right, so here's that clean 1 hour chart. Small little imbalance in here, trades down into that, rallies, and then drops back down in. So ahead of this imbalance, this low right here. What I'm looking for is swing lows and swing highs. Not every swing high is important. Like this swing high here, not terribly important. This one is. Why? Look how much energy there was used to get away from that high. Much like this low here was energetic because we had this imbalance here. So we have displacement. So I'm going to look at this low and this high. Now let me rephrase that again so that we understand why I'm picking them. This swing low has a lot of energy moving away from it. This swing low has a lot of energy moving away from it. This one also, but we're not using this one because the low here went lower than that. So we already are below it here. This is the next short-term swing low to the left of this low prior to this run up. Swing low, the swing high, 50%. At this moment here, we're at a discount. Trades down into 79% retracement level here. For entry purposes, right here, and you can see how nice that aligns with the bodies. And then you have one negative standard deviation on the upside to 92 and 10. And 92 and 10 is there, essentially, right there. So the fib does a fairly decent job in terms of calling a high. And also, that is that volume imbalance on the daily chart. So I'm going to take this off and add the 15-minute time frame. Okay, and the market trades back down into, after non-farm payroll, the small little imbalance here. So we'll see if it wants to go higher. If it takes out this low, we'll have to consider this imbalance in here. Okay, so just be mindful that it's already set the stage for a stop run here, and this was just consolidating into close on Friday. So I'd like to see it gap higher on Sunday, trade down, and then resume going higher. That would be what I would like to see. But if it does need to retrace, focus right in here. Okay, it's better it doesn't do that. Let's go to the euro dollar now. All right, here's the euro dollar daily chart, and you can see how nice we moved away from that fair value gap here. Traded back up into the sell side imbalance, buy side inefficiency, institutional order flow entry drill, and expansion on the downside. All these days here, I said I wanted to see it be heavy, remaining lower, attacking the sell side liquidity here. We have a bullish order block right in here, which is an old high as well. So this is mitigation, or a mitigation block, and then we have overlapping with these two down close candles, which is also a order block. We could get a bounce in here that might set a stage to see it maybe return back to this low. I'd like to see it not do that. Okay, in other words, I'd like to see something like this form, where it just trades above a little gap, create one candle high here, then go back above it later on for institutional order flow entry drill. So I would like to see that type of pattern here form between this level and this level. And then I would expect more selling pressure. And if it can get really animated on the upside for dollar, this is what I'd like to see for euro. It's too clean, and also it's a market maker sell model. So we'll see what happens. All bets are off if we trade back up into the CIVI. It does not need to go back up in here. If it does, then we've basically taken out sell side here and made a longer term or intermediate term turning point by running down here. I don't see that in the cards right now, but that would be the changing of my mind, if you will. Not plan B. It just means ICT was wrong about getting down to here or here, and we'd have to revisit the idea of going long after it does this. Not on the basis of it just simply going there, then we're long. No, it needs to create something else in addition to that. Okay, so again, not plan A, plan B. It's I'm looking for lower. I'd like to see it form another sell signal between this level and this level, similar like we did here, and then move lower. We're going to drop down to the hourly chart. All right, so here's that sell side imbalance, buy side inefficiency in the institutional order flow entry drill right here. Small little fair value gap, bearish order block, trades to it here, sells off. It stays heavy, and I mentioned this all through here in your commentaries. I didn't want to see it make any attempt to go higher, just stay heavy and roll over, and it did that. The market trades aggressively lower here on Thursday, and then does this a really quiet continuation, and then choppiness into Friday's non-farm payroll. So for the most part, you know, if it rallies, think right in here. It can go back above that low and tap into this. But anything more than that is, in my mind, concerning, and it may be a return back into the CIVI here, which would be not bearish in my mind. Okay. All right. And for the hourly chart, that's my swing trading time frame. Here's your price swing. We're using the bodies of the candles here to here, and -1 standard deviation takes us down to 1.1903 and 3 pipettes, extended out in time. The bodies respect it. We have one little wick that drops down in here, and it's all non-farm payroll related, but it doesn't really do anything after that. Notice that? So a really nice level here. If it starts to break down, in other words, this bearish order block, fair value gap, sell off right here, you could be thinking about this target and this target while back here, which is pretty decent. And we're going to drop down to the 15-minute time frame, and you can see it's just a really sloppy chart. Yes, went lower because the dollar went higher, but nothing in here terribly exciting relative equal highs, traded up into that after non-farm payroll, and didn't even take out the low that was formed here on non-farm payroll release. So just nothing really terribly exciting about this pair here. Run over to cable. All right, here's the British pound versus the US dollar, or cable daily chart. Buy side imbalance, sell side inefficiency here. So we have that also as a downside draw on liquidity still. We have a volume imbalance. It trades up into here on Thursday and then breaks down. Another lower run on Friday, and I want to see it trade into this. I want to do a complete closure of this. That's what I'd like to see. So we're looking at this candle's high at 137.49 and 4 pipettes. We'll just call it a round number, 137 mid-figure, or 137.50. Just going to drop into the hourly chart now. All right, here is the hourly chart on the British pound, and you can see we had the market drop down in on Friday. Non-farm payroll reaches up into this fair value gap, but overshoots it, goes right back up into this wick here. So then after that, retraces lower. I want you to look at this market and where the market structure is and how we can use that hourly chart swing trading targeting technique I've been teaching you for the last couple of times we've been meeting here. Can you find the swing? Pause the video, think about it before you see where I do it. If you didn't pause it, I'm about to show you. All right, we're using this area in here, using the highest closing or opening price down to the lowest opening or closing price. Right there. Now, why am I using this and not this? Because this went lower than that. So all of this run up, if it breaks this low here, we start looking for projections lower. Now this is a nice one because it overlaps with that. So that's -1 standard deviation. And then you have -2 standard deviations taking us down to 137 and 91. Beautiful. This right here is just simply ahead of the non-farm payroll numbers. So volatility, it's not a big deal. But look how it encapsulates the bodies and does get 1, 2 runs on the hourly chart as a target. I don't try to get too excited about the idea of it being too precise on a non-farm payroll event, but for swing trading here, it's really nice to be able to do that. And you're just looking for convergences. You can look at the imbalance, which was that buy side imbalance, sell side inefficiency in the form of a fair value gap on the daily chart. That's what these levels are. This is the premium level, this is the discount level, that daily buy side imbalance, sell side inefficiency, or fair value gap. So that level comes in just ahead or above this fib. That could have been your target, and then allowing for this, for price to reach into it. And this would be your moral victory, whereas you're trying to get out here. Okay. Let's drop into the 15-minute time frame. All right, here's the pound dollar 15-minute time frame. Small little fair value gap in here as it ran down on non-farm payroll Friday. The numbers release here, runs lower, runs right back up into the imbalance here, and then sensitivity. So these are the things I like to study on non-farm payroll. Not that I want to trade it, but I like to see, does it support the theories and things that I teach you? And I find it fascinating that it still does that, but you still get these weird price runs, and then it just simply sometimes goes quiet where it doesn't do anything. You have to be so pinpoint accurate on this day, or you're likely to lose money. And that's really what I want to get at this week. And I don't want you to feel like going forward, when I make this comment that I make every single week, that we don't try to trade on Thursday and Friday of non-farm payroll week. Even though there's movement, study it. That's all you need to be worrying about right now. Okay? There's plenty of other moves that take place throughout the month. So now I'm going to take your attention over to the gold market and talk about that and the dollar index, because there were some things that I leaned on in reference to the daily dollar. And let's put this chart on a daily, and we're going to pull up gold futures. Now usually you guys look at the pair versus the dollar. Okay, in other words, gold versus dollar. I'm looking at the actual gold futures contract, and the symbol for that is GC. And we're going to go down to April gold. Okay, the nearby contract right now is March, but that's about to expire, so I'm going to be using the data for April 21st. What's significant about these 2 months? Well, right now there's more open interest here in April, and I'm going to show you that in a moment when I go over to barchart.com. Okay, so this is a website I like to use, and again, just type in barchart period com in the browser, and then you'll get this page here. And I like to look at, here's your March contract. Right over here is open interest. You see that? It's less than 1,000 contracts being traded, and the most open interest is at 321,000, almost 322,000 contracts being traded on the April contract. So all the activity is in April contract for gold. All right, so that's the business there. If we go back to the gold chart here, and I'm going to split the screen here just for me to be able to talk about dollar index and gold at the same time and make some comparisons and tell you why I was feeling what I was feeling about this rejection block, why it could have been problematic, and it was, for any continuation lower and the subsequent rally up to where I said it was going to go over here. If you look at what is going on in gold, here's January 2021 in gold. It creates the high, and we have been trading lower since. January is the low in dollar, and it's been going higher since. So for those of you that hammer me all the time in email, and you know who you are always asking me, please, can you talk about gold? And I'm going to tell you, I'm essentially talking about gold every time I mention dollar. Okay, if you haven't already picked up on it, there's an inverse relationship between dollar and gold. Now, every time from January, when the market traded lower, we have an institutional order flow entry drill here. It starts to sell off. So there should be a buy in the vicinity of January 20th, January 21st, or January 22nd. Okay, in here. Why am I saying it like that? Because it's not always going to be day for day, mark to market, or a mirror image, in other words. So if this is the high here, right there, on the 21st, there's going to be a buy in dollar on the 20th, the 21st, or the 22nd. Now, if you look down here at the date, I'm using the highest point here for that swing high. It's saying that it's the 21st of January. So that means there's going to be this factor of day before, day of, or day after. It's just the way it is. It's not always a mirror image in gold to dollar. Sometimes there's a little bit of a head start in gold. Sometimes gold lags a little bit. But by far and large, there's usually this balancing act between the two. One goes up, the other goes down, vice versa. Well, if this is the 21st of January, we're going to be looking for a long or a buy the 20th, the 21st, or the 22nd of January. There's your 21st, creating the low. So it matches up with the highest high in that swing right there. You see that? And then it rallies. Here's another opportunity here where it starts to sell off. It's January 29th. So you know it's going to be what? It's going to be the 29th, the 28th, or the 1st of February. Here's the 28th, the 29th, there's your low, and it rallies. Now, here's where it gets a little squirrely. When we have this breakdown like this, notice that we are not getting a heavy rally here. This is indicative of this is just likely pulling back, and I have to refer to something that it could be tracing to, which is this rejection block. So when it starts to drop down like this here, while gold is not rallying higher, this indicated to me that this is likely a trap, and it will turn on that rejection block. Otherwise, gold should have been rallying. Here on February 10th is a sell-off for gold. That means February 9th, 10th, or 11th, and thereabouts should be a buy in the dollar. Here's February 10th, 11th, 12th, and we have that little rally here. It breaks down. Then on this day right here, the 25th of February, there's your run higher and low forming once it hits the rejection block. That date is the 25th of February. The 25th of February is here. It's already created a swing high. High, lower high to the left of it, lower high to the right of it. The next day, this has been doing what? Going lower. So this day should be a sell-off day. And if it trades that rejection block on that day, go back and listen to your recordings, that's going to be problematic for going short, and it's probably going to be going higher. And you get this big drop off here in gold, and you get this big run up in dollar. On here, on the dollar index, March 3rd, we have the institutional order flow entry drill here within this buy side imbalance, sell side inefficiency, and bullish breaker. So there should be a sell-off on March 3rd in gold. March 3rd, sells off. We get this run here to the imbalance. So there's this constant balancing act. I'm not just simply looking at dollar in and of itself. I'm looking at intermarket relationships. Okay, so this is intermarket analysis. Intermarket analysis is where we look at markets that are supportive in helping us determine what a particular market should do. So in other words, we like to look at the euro dollar and British pound in relationship to the dollar. But how do we look at the dollar? We have to look at commodity markets. Commodity markets will be opposite to what we see in the dollar index. And gold is a commodity. And this is what we're reading here, which is supportive over here. It's not always going to be day for day. It's not going to be on the same day. And sometimes you're going to see things like this move here that isn't reflected in a buying opportunity where it's going higher up, whereas it went down here. This, with the gold market, acts very similar to an SMT divergence. While I'm not showing you a divergence per se, I'm showing you the relationship of how this drop down here isn't really confirmed with a rally higher in gold as you would expect to see it. Okay, so when I'm looking at dollar, even though I'm not walking you through this or looking at it in terms of other commodities that we'll talk about as we go out throughout this year, the dollar doesn't always stand on its own with me. I have to look at other things that support it. And one of the things I like to look at behind the scenes is the gold market. And I don't trade gold a lot, but if there's an opportunity for it to be an event-driven move, then I will trade gold. Because essentially, I'm trading gold when I'm trading opposite to what the dollar index is doing when I'm trading euro or cable. It's the same trade. If you look at this drop down here, and we look at the euro dollar, here's January, it's gone lower. Here's January, it's gone lower. They're both doing the same thing, opposite to dollar. So that's why I said if we get up to here, this might be an opportunity for us to see an opportunity to sell off. If it does, then we'll go back to thinking about this low here. And we have it. So there's always this forecasting model that I'm using that's always referring to something more than just the dollar index, okay? And it's gold, okay? So if we found this insightful, until I talk to you on Monday, enjoy your Sunday and be safe.